The New York housing marketplace just underwent a tectonic shift that virtually everyone completely overlooked. And what's developing right now will determine whether you ever own property, how much you'll pay in rent, and whether your home becomes your greatest wealth builder or your most devastating financial burden. Lending standards just got relaxed in ways that could spark another boom or engineer complete disaster. A massive departure of individual landlords, while corporate giants quietly acquire entire city blocks. Tax proposals being discussed in Albany that could devastate millions of property owners. And an inventory explosion that's producing completely counterintuitive effects on valuations. If you own, rent, or aspire to purchase, these forces are reshaping your financial reality right now. This isn't another housing cycle. This is structural transformation. And once you comprehend what's genuinely happening, you'll never perceive the real estate marketplace the same way again. Let me reveal exactly what's changed and why it matters directly to you. Write in the comments, New York Housing Truth, if you demand transparency about what's really happening to our property market. We'll begin with the bombshell that's been concealed in plain sight. Federal housing regulators dropped new guidance back in March that flew completely beneath public awareness. But it's already reshaping who can purchase property in New York and who cannot. Ever since the 2008 financial catastrophe, every mortgage application has been subjected to rigorous stress analysis. Banks don't simply verify you can manage today's obligations. They simulate whether you'd survive if interest rates suddenly spiked by 3 or 4 percentage points. The reasoning appeared sound after the collapse. Protect borrowers from overextending themselves. Protect the financial system from another meltdown. But here's where circumstances get fascinating. We're currently in a declining rate environment in 2025. Yet lenders have been stress testing applications as though rates were about to explode upward. They've been utilizing reversion rates, those punishing rates you get transferred onto when your fixed arrangement expires, and then adding extra margin on top of that. In practical terms, this locked thousands of perfectly qualified buyers out of the marketplace. People who could comfortably afford their mortgage at actual market rates couldn't pass these catastrophic scenario tests. Federal regulators finally intervened and informed lenders they possessed way more flexibility than they were exercising. Tests based on realistic 5-year projections, not apocalyptic worst-case scenarios. If rates are declining, your stress tests need to acknowledge reality. They also reminded banks about their consumer protection requirements. Translation: stop designing lending criteria that unnecessarily exclude individuals who can genuinely afford to borrow. This is a significant loosening of restrictions. It's not as dramatic as eliminating stress tests completely, but it's a clear message from regulators. More approvals, more transactions, more marketplace activity. Stay right here, because what I'm about to reveal next will show you exactly how these lending changes are setting up the next property crisis. Then July brought an even bigger transformation. Federal banking regulators simplified the entire mortgage regulatory framework, stripped away obsolete red tape, and made it substantially easier for individuals to switch lenders and modify their borrowing terms. Refinancing became more streamlined. You can now accelerate mortgage repayments without drowning in bureaucracy. You can have preliminary discussions with lenders without triggering full regulatory advice processes every single time. The system is opening up, and it's happening rapidly. On top of this, the debt-to-income ratio restrictions shifted. From July onwards, only lenders issuing over $200 million annually must follow strict rules capping high debt-to-income mortgages at a specific percentage of their total lending. Smaller lenders got exempted. What does this mean in actual practice? More lenders can now offer 6 or even 7 times your annual income, instead of the traditional 4 times income limitation. Plus, there's renewed government mortgage assistance programs, helping lenders approve buyers with smaller down payments. So here's the question everyone should be demanding answers to. But isn't? Is this genuinely about helping people afford homes? Or is this about propping up property valuations? Because when you make borrowing easier, you don't necessarily improve affordability. You increase demand. And when inventory remains constrained, that demand doesn't drive valuations down. It pushes them right back upward. The government and regulators desperately want growth, want activity, want transactions flowing. But growth built on expanded credit has a nasty track record of ending in disaster. We've witnessed this film before, haven't we? Which takes us directly to the next force colliding with everything else. Zillow and Realtor.com are both recording the highest volume of properties listed for sale in over a decade. Listings jumped 12% year over year, which sounds like fantastic news for buyers. More options, more competition among sellers, better negotiating power. Except, there's a critical problem. Demand only increased 5%. That gap is hugely significant. Sellers are now chasing buyers rather than the reverse, creating a completely different marketplace dynamic than the pandemic feeding frenzy. Don't go anywhere, because what comes next exposes why so many New York homeowners are being forced to sell right now. Industry forecasts predict property price growth will slow to between 1 and 2% for 2025. When you factor in inflation, that's basically flat. Some neighborhoods might see marginal gains, others slight drops. But the overall picture is stagnation. So why are so many people suddenly listing their properties? It's not because marketplace conditions look attractive. It's because they have absolutely no choice. Remember all those buyers who locked in incredibly cheap mortgage arrangements during 2020 and 2021? Rates were sitting at 2.5%, sometimes lower. Those fixed-term arrangements are expiring right now, and homeowners are confronting a brutal reality. Their monthly obligations are jumping 30, 40, sometimes 50%. Thousands of households simply cannot afford to refinance at current rates, even with the relaxed lending rules we just discussed. So they're selling instead. This isn't a trickle. This is a tidal wave, and it's just beginning. Real estate agents throughout New York are witnessing the same pattern. Motivated sellers, realistic pricing expectations, extended time on marketplace. Properties that sold within days during the pandemic now sit for weeks or months. Buyers have more leverage than they've had in years, but only if they can actually secure mortgage approval and stomach the new rates. The inventory surge should theoretically be positive, but it's a symptom of financial distress, not marketplace health. And here's the kicker. The government understands this perfectly. That's precisely why they're so eager to loosen lending standards, enable people to borrow more money, push additional buyers into the marketplace. Because if they don't, if demand stays weak while inventory keeps flooding in, valuations don't just stagnate, they start falling. And falling property valuations terrify policymakers more than almost any other economic scenario. Property wealth underpins consumer spending, finances retirement plans, backs loans throughout the entire economy. A crash doesn't just devastate homeowners, it threatens the whole system. Keep watching, because what I'm about to share next reveals which landlords are actually good for tenants and which ones the policies are protecting. But while every day sellers struggle and compete, a completely different group is making calculated moves. New York's strengthened rent regulations and escalating tax pressure are driving landlords out of the marketplace at unprecedented speed. On the surface, that sounds brilliant. Fewer landlords competing for properties means less competition for first-time buyers. Correct? Except it's nowhere near that simple. Short-term, rental inventory is plummeting, which means rents are climbing even higher. Long-term, the landlords exiting aren't the ones tenants should want to lose. Recent housing studies examining New York landlord behavior, neutral statistical research analyzing how different landlord types actually operate, revealed findings that are deeply uncomfortable. Large landlords, those owning 5 or more properties, are twice as likely to have evicted a tenant within the past year. They're significantly more likely to increase rent between tenancies or during renewals. 77% of large landlords raised rent for new tenants. 65% increased it for renewals. They adjust rent based purely on marketplace dynamics. No emotion, no flexibility. Small landlords, those with just 1 or 2 properties, are far more likely to hold rent steady, especially for long-standing tenants. They're often emotionally invested, more flexible, more willing to accommodate tenants facing temporary difficulties. And according to research data, these small landlords are the ones planning to exit. Increased regulation, reduced tax advantages, uncertainty surrounding rent control expansions. Those are their top reasons for leaving. Who's staying? The major players. Those with 5, 10, 50, 100 properties. The ones statistically more likely to evict, more likely to maximize rent, more likely to treat tenants as line items on spreadsheets. So while the stated objective is protecting renters, the actual policy outcome is pushing out statistically better landlords and retaining the ones tenants are most likely to experience problems with. This is the identical pattern playing out across every industry. Independent coffee shops crushed by Starbucks, family-run restaurants replaced by soulless corporate chains. Yellow cab drivers displaced by Uber's algorithm, not because the big players deliver better service, but because they can handle regulatory complexity at scale, absorb compliance costs, and optimize through systems. What gets lost? Personal service, flexibility, local relationships. That's exactly what's happening in rental housing right now. Stay with me, because what comes next exposes the corporations buying entire New York neighborhoods before properties even hit the market. This legislation will worsen wealth inequality, not solve the housing crisis. It's consolidating rental property into fewer, wealthier hands. Corporations, institutions, and large portfolio landlords are expanding aggressively, while ordinary people get squeezed out. Which brings us directly to the most disturbing development of all. We're no longer just competing with everyday landlords or small-scale investors. We're competing with Blackstone, Starwood Capital, related companies, Brookfield Asset Management. These aren't companies dabbling in property as a side venture. They own thousands upon thousands of homes, not scattered individual purchases, entire developments, whole blocks purchased before they even reach the open marketplace. Blackstone has gone so far as to acquire stakes in construction material suppliers. Let that sink in for a moment. They're not just buying finished properties. They're controlling the supply chain, the literal building blocks of New York housing. That's their level of confidence that this marketplace is worth dominating long-term. Other massive players are acquiring development sites, land parcels, anything with growth potential. Why? Because housing has become one of the safest, most profitable investments globally. Inflation drives rents upward, debt remains fixed or gets cheaper in real terms. People always need somewhere to live, regardless of economic conditions. Even when everything else collapses, people pay rent. They must. It's not optional. These corporations understand something fundamental that most individuals completely miss. Housing isn't primarily shelter anymore. It's a financial asset class. And it's too lucrative to leave in the hands of ordinary people. Remember Maslow's hierarchy of needs, food, water, shelter at the foundation, the absolute essentials for survival. Corporate landlords recognize they're providing one of those essentials, which means demand is completely inelastic. Tenants cannot simply decide not to rent. They cannot boycott or shop around indefinitely. They need a roof over their heads, and they'll pay whatever the marketplace demands. That's why institutional investors view New York housing as a gold mine. This shift fundamentally transforms the game. When your landlord is an individual, there's space for negotiation, for human understanding, for flexibility during hardship. When your landlord is an algorithm optimizing shareholder returns, you're just a data point. Rent increases because the model dictates it should. Maintenance gets delayed because it impacts quarterly profits. Evictions happen faster because there's no personal relationship creating friction in the process. Don't click away, because what I'm about to reveal next shows you the tax proposals that could force millions of New York homeowners to sell. The individual landlord exodus isn't creating opportunities for regular buyers. It's creating a feeding frenzy for institutional capital. And once these corporations control enough housing inventory, they don't just control shelter. They control a massive portion of household income, consumer spending power, and economic stability. That concentration of power should deeply concern everyone, whether you rent or own. But the final force reshaping New York property might be the most explosive of all. New York State collected over $3 billion from real estate transfer taxes last year. And that's despite transaction volumes being significantly down. The tax revenue from property is enormous, and the government knows it precisely. But behind closed doors in Albany, policy advisors and think tanks are advocating for something far more ambitious: a revised property tax structure that would substantially increase taxes on high-value properties. Leaked proposals suggest new levies specifically targeting properties worth over $750,000. If that sounds like it would only impact the wealthy, think again. In Manhattan, you'll find one-bedroom apartments selling for $750,000. Throughout the outer boroughs, ordinary family homes are well above that threshold. This isn't about taxing billionaires and penthouse owners. This is about extracting more revenue from middle-class homeowners who've watched their property values climb. Not because they're wealthy, but because the marketplace went insane. The political appeal is transparent. Property wealth is concentrated among older voters who already own homes. Younger voters locked out of ownership are far more supportive of taxing property wealth. It's a tempting way to raise revenue, without touching income tax or sales tax directly. But the consequences could be seismic. Homeowners above the threshold would face annual bills potentially worth thousands of dollars. Some would be forced to sell. Others would watch their retirement plans disintegrate. The New York property marketplace, already under pressure, could face a sudden correction. Nobody knows exactly what form these tax changes will take or when they'll arrive. But the trajectory is crystal clear. The state needs revenue. And property is one of the few areas left with substantial untapped wealth. Transfer taxes already generated $3 billion in a slow marketplace. Imagine what comprehensive property tax reform could extract. The danger is, it triggers a downward spiral. Forced sales increase inventory. Valuations drop. More homeowners find themselves underwater. More forced sales follow. It's a feedback loop that's incredibly difficult to stop once it starts. Here's where we actually are. Mortgages are easier to obtain, which sounds positive until you realize it risks inflating valuations all over again. Inventory is surging, but primarily because people are being forced to sell, not because the marketplace is healthy. Small landlords are fleeing while corporate giants circle like predators, ready to acquire everything they abandon. And tax proposals are being drafted that could upend the entire marketplace. For anyone with property worth over $750,000. These five forces aren't separate issues. They're interconnected, feeding into each other, creating a system that increasingly feels rigged against ordinary people. Easier borrowing props up valuations so sellers can exit without crashing the marketplace. The landlord exodus creates opportunities for institutions to consolidate power. Tax changes could force additional sales, giving corporations even more buying opportunities. Everything points in one direction. Housing is being transformed from something people own into something people rent from massive corporations. The New York property marketplace hasn't just shifted in 2025. It's been fundamentally restructured. The question isn't whether you approve of these changes. The question is whether you understand them well enough to make intelligent decisions for your own situation. Do these forces stabilize the marketplace, or are we heading towards something completely unrecognizable? Share your thoughts in the comments. I genuinely read almost every single one, and I learn from your perspectives. If you found this breakdown valuable, subscribe and hit the bell so you never miss the next update. More importantly, share this with someone who needs to understand what's really happening. The more people who see through the noise, the more pressure we can apply to policymakers to actually fix the system instead of just propping it up. Hit that like button if this investigation opened your eyes to what's really happening in New York real estate. Comment below with demand housing reform if you're ready to hold officials accountable for these structural changes. Share this video with at least 3 people who own or rent in New York because they deserve to know the truth. What happens next affects all of us, whether we own, rent, or we're still trying to get that first foot on the ladder. Knowledge is power.